Good morning from Finland and welcome to our live stream. My name is Konstantin Nylander. I'm the chairman of Talousdemokratia Finland, one of the organizers today. And our topic today is Eurozone and its multiple currency possibilities. And today we're dreaming of the perfect currency arrangement for the Eurozone. We have two great speakers today, Professors Bill Mitchell and Professor Heikki Patomäki. I will give them more appropriate introductions later, but first a few words from our organizers. So I will start with Talousdemokratia. We are a Finnish non-profit organization aiming for a more just monetary system, and which are also trying to spread information about how the system actually works. And today is one of our events for sharing this other possibilities for our monetary system. And we're also interested in central banks, digital currency, and debt-free money. Next, we have Nina Kari from University of Helsinki ATTAC to give us a few words. How are you, Nina?
I'm very well, and I'm really glad to have this event. Very exciting, a very interesting topic and good speakers. So I'm from University of Helsinki ATTAC. So it's an association for the taxation of financial transactions and citizens' action. I decided to do the English version because I didn't want to butcher the French language. But basically, it's an activist organization for a more just, democratic and equitable economy. In Finland, ATTAC has campaigned against tax evasion and austerity policies, for example. And University of ATTAC is kind of like the nerdy wing. So we organize a lot of lectures and reading circles and movie nights, as well as a shadow course in economics that was very popular. So we could maybe do that again if there's interest. And if you're interested in our organization, you can just send me an email. We'll be sharing contact information at the end of the event. And you can also send me the audience questions. So that's Nina with 2 I's, Kari@helsinki.fi. But you can also do audience questions here in the comment section. And there's my email. So yeah, welcome everyone.
All right, thank you, Nina. Then we have Rubens from Rethinking Economics Finland. Welcome, Ruben.
Hello, thank you. Yeah, just a very few words about Rethinking Economics. The organization was born about 10 years ago after the great financial crisis, and it was born from a lack of pluralism in economic departments in response to it. So the main aim of our organization, which is a really broad global network by today, is to introduce a more diverse perspective on the study of economics. So it's composed mostly by scholars, but it has also it has broadened up in scope. And nowadays, it's not just about introducing diversity for the intrinsic value of it, but also to challenge and also foster, let's say, critical thinking and realistic thinking that challenges mainstream consensus around topical issues such as climate change, democracy, or gender structures and colonial structures. So yeah, we just are very happy to announce that we started the Finnish branch since this year. So we're active also in Finland. We're organizing some seminars. The next one will be on the 22nd of October about the relation between economics and the natural environment. Welcome to join. And today we're really much looking forward to hear what the two great speakers have to tell us about different currency arrangements and how they impact democracy and other institutions.
Thank you, Ruben. A few words about the schedule today. So after the introductions, we have now Bill Mitchell to give his 30-minute lecture. And after that, we have space for maybe if you get questions, you can put them to the YouTube chat or email Nina at the email below, and we will pick the best ones for it. And after that, we have Heikki Patomäki to give his lecture, 30 minutes, and also a few questions. And after that, we have a panel discussion about the subject, where you can also few questions. All right. Well, the first lecturer is Professor Bill William Mitchell, who is one of the main advocates of MMT, modern monetary theory, and also the professor of economics from University of Newcastle. Welcome to the broadcast, Bill.
Thanks very much.
So how is Australia today?
We're entering late spring, so it's very warm. It's early evening now for us. So, yeah, I mean, it's a nice time of year, but it's a pretty torrid time with the COVID and all the rest of the restrictions. We've been in very long lockdowns for months, and yeah, quite tricky. And we're now trying to negotiate. Our governments are negotiating with us a sort of contract to get out of it and free up again, and everybody's deeply uncertain about that. And there's been a massive rush to vaccinate, and we're all just now in this almost a twilight zone where we want to be free, but we want to go back to, inverted commas, normal lives, but nobody really knows what's going to be ahead of us once they start opening the bars and travel. I mean, we've had our border closed to the rest of the world since March last year, and most of our internal borders between our states have been closed. So we just don't know what's the next 6 months is going to be like here.
All right. Well, we're very glad to have you here. You're probably our participant from furthest away, but if you are even further away from Newcastle, Australia, please leave a comment on the YouTube section. All right, then we have also Heikki Patomäki, the professor of political science in the University of Helsinki. How are you today, Heikki?
I'm fine, thank you.
Okay. Great.
Sorry about that.
So how is the morning, Saturday morning in Helsinki?
Well, it's the sun is shining. It's beautiful autumn weather, and everything seems to be fine, and life is returning back to normal in Finland.
Yeah, there seems to be some differences between Australia and Finland, but we are not here to talk about that today that much, but about the Eurozone and the currency arrangements. So I'll just hand out to you, Bill, the lead, and you have around 30 minutes to present and maybe a few questions after that. So go ahead.
Okay, well, thanks very much, and thanks to the organisers, and it's great to see Heikki again, and I'm very thankful that you've invited me to be part of this. These type of events are keeping the dialogue going and allowing people of all persuasions, progressive or otherwise, to hear about issues and come to terms with differences of opinion. So what I want to talk about briefly is the first questions I'm going to address are relating to the capacities of a currency issuer and the consequences of not using a foreign currency. So I've got about three or four questions that I'll deal with in the next, hopefully, 25 odd minutes. And when we think about what does it mean to be a currency issuer, and note what that means is that Australia, the US, UK, and almost every country issues its own currency, whereas the 19 member states of the Economic and Monetary Union use effectively a foreign currency. And the euro is a foreign currency to each of the member states. And so that juxtaposition raises serious differences between the way in which policy space can be defined and the way in which governments can respond to external changes in their economic environment. And I'll talk about that briefly to start with. When we think about having your own currency, what we're doing really is defining a very broad fiscal space. Now, typically, multilateral institutions and mainstream economists talk about fiscal space in terms of financial ratios, like what size deficit you've got or surplus, and how much public debt you've got relative to the size of your economy. Whereas modern monetary theory, the paradigm that I work in, doesn't think of fiscal space in those terms at all. We think in terms of real resource availability. And when we think about a currency issuing government, we understand intrinsically that that government can buy whatever is for sale at any time in that currency. And what that means is that there's no financial constraint on that type of government. And the mainstream economists typically hold out a concept that they use this household budget analogy to define the prospects of a currency issuing government. Now, I'm a household, all of us are households in this event tonight. And as a household, I have a financial constraint on my spending. I've got to go to work, as I am now. I've got to earn income, or I can run down prior savings, or I can sell an asset on eBay, or if all of that runs short of my spending aspirations, I can then go to a borrowing agency and borrow and raise debt for a house or something like that. And that's an intrinsic constraint on my spending capacity because I'm a household. Now, to think that that experience provides any knowledge about the capacities of a currency issuing government is just flawed. It's false. At the most elemental level, a currency issuing government has no financial constraints. And so what that insight leads you to is to ask other questions. Well, if it can spend whatever it wants, whenever, however much, what are the constraints? And then you're starting to ask different questions, and you're asking, well, if it's got no financial constraints, why does it raise taxes? Because in the mainstream paradigm, taxes allegedly are funding government spending. But if the government issues its own currency, it doesn't need to get funding from somewhere else. And so what's the purpose of taxation? And similarly, another question that immediately comes to mind is, well, why do they issue debt? All national governments issue debt into primary debt markets, and that causes an incredible political debate about size of the debt, and is it going to be too much, and are there debt thresholds beyond which a government will become insolvent? Once you understand that a currency issuing government has no financial constraint, all those questions are abandoned. And so then you have to ask yourself, well, why do they issue debt? Different questions. And you also come to understand that if it has no financial constraints and can buy whatever is available for sale in that currency, then that means it could buy all idle labour workers who are unemployed and put them back into productive use. And what that immediately leads you to think about is that, well, we've been told relentlessly by our governments that unemployment's a complex problem, that they don't have enough, that they can't afford to have full employment or whatever. But once you understand that there's no financial constraint, then you know that mass unemployment is a political choice. It's not a financial choice at all, it's a political choice. Now, think about two scenarios. One is where the economy is already at full employment, and that means all the productive resources are being used. Now, in that context, if the government, gets an electoral mandate for a major green transition, for example, to deal with climate change, which will require fundamental changes in production and consumption patterns, but also a fundamental shift between resource use in the public sector relative to the non-government sector. Now, in that context, the government can clearly extract those fully employed resources and bring them into the government sector to pursue its new political agenda that I've just defined. And it would have to then, to gain access to those resources and bring them into the public sector, it would have to compete with the existing users at market prices. Now, suddenly you realise what the constraint on spending becomes. It's not that it can't do that. It can type whatever numbers it likes into bank accounts to compete for those resources. But in competing for them at market prices, if they're already fully used, it's got to pay above the current market price, and that will become inflationary. And so there's the constraint. It's a real resource constraint. Now, take a second scenario. And back to the first scenario, sorry. So if it wants to maintain that agenda and shift resources into the government sector away from where they're fully used elsewhere, then it has to somehow deprive the existing users of those resources of the use. How does it do that? It has to reduce the purchasing power. How does it do that? There's a role for taxation. It's one of the many roles of taxation, but it's an important role. That taxation doesn't fund spending. It doesn't give the government any more spending capacity. What it gives the government is the creation of resource space into which it can spend without causing inflation. So the taxation reduces our ability to demand those resources and put them to use. Those resources then, if nothing else happened, would be effectively idle, and the government then can bring them into productive use through its own spending without putting market pressure and creating inflation. Now, take scenario 2. This is an economy of typical these days where you've got mass unemployment, idle capacity, machines not being fully used, unused technology, lots of unused workers. Now, in that context, what's the constraint on government spending? None. There's no financial constraint by definition, and there's no real resource constraint because that idle labour has no market bid for its services. That's the definition of unemployment. There's no market price for it. And so the government can bring in, through increased spending, and there's a variety of ways it could do this, bring those resources back into productive use, either directly into the public sector or by stimulating the non-government sector to bring them back into use there. Now, until we reach full capacity again, the government has no constraint. Now, think about the consequences of not having your own currency like an EMU country, like Finland. Now, in that context, in the first scenario, the national government has a financial constraint and a real constraint in the same way as the currency issuing government has. So it has an additional constraint on fiscal activity. It has a financial constraint. Why? Because it uses a foreign currency. Now, what does that mean? It means that if it wants to spend in that currency, say the euro, it has to raise taxes and extract euros from the non-government sector, store them up and then spend. Whereas a currency issuing government has no constraint like that. And if a non-currency issuing government like Finland, for example, wants to spend more than it can raise in taxes, then it has to borrow through bond markets and raise and issue debt and allow itself to spend more than its taxes. Now, in a typical environment where if in a growth environment, that financial constraint is unlikely to be terribly important. Bond markets will lend to governments to want to run small deficits. They know that the economy is growing strongly and will be generating tax revenue, so they've got no. While they understand that government has credit risk, meaning it could run out of money because it doesn't issue its currency, in a growth environment, that those sort of fears are less binding. But the real problem comes about in the second scenario, because you could have mass unemployment. Go back to the global financial crisis. You can have mass unemployment, a declining tax revenue, increased welfare spending, increased deficits, not necessarily even through discretionary decisions taken by government, but through the so-called automatic stabilisers. You know, when the automatic stabilisers work through the cycle, and, you know, the taxation revenue falls immediately because there's less activity, and welfare payments rise automatically just because of the structure of the system, the welfare system. Now, in that environment, the government has to run an increased deficit, will run an increased deficit, but probably needs to run an even bigger one to stimulate the non-government sector, to reduce mass unemployment. But in that environment, the bond markets might form the view that that debt is increasingly risky, that the danger of default is increasingly likely, and they certainly did this in 2010 in Europe. And in that case, they'll start demanding higher and higher risk premiums. In other words, in the auctions, they'll demand higher yields. And eventually you could get to a stage, which several governments in 2010 did too, where the yields would be so high that there'd be a high risk of default and insolvency, and the government would be without sufficient funds to continue. And that's the consequence of not having your own currency. A government like Australia or the US or the UK or Japan, or almost all governments, can never really get into that situation because there's no credit risk on their debt, and the bond markets know that. And so that's a major juxtaposition. So the second thing I want to talk about is why the EMU chose the architecture that it did. And the important point is about this is that it embeds neoliberalism into its very legal structure. Now, what does that mean? That most countries in a neoliberal era are infested with that ideology. That's the point. Australia has a neoliberal government, but the difference is that that's a fashion in our context. It hasn't become embedded in our very constitutional and legal structure, whereas in the European case, it certainly has. Now, if you go back to the early post-Second World War days, you'll realise that the great, and they were all men, the great men of Europe had a desire to have increased integration in Europe, and this was largely driven by French aspirations to stop Germany ever engaging in war on the continent again after many years of military battles on the continent. And as France was the victor and Germany was the defeated, France believed that it could assert its influence in Europe by creating structures that would make it impossible for Germany to repeat its incursions of the past. And so there was a whole debate about how that integration could occur. But the important point was that the European leaders at the time were embracing in economic terms, the Keynesian era, where governments took responsibility for full employment and to sustain growth through the use of fiscal and monetary policy. And they stood ready to make sure there was enough spending in the economy to ensure there was enough growth in production and sales to employ people. Now, the various attempts in the 60s and the 70s to come up with a plan on what integration might look like, they all stumbled. So there was the Werner report in 1970, there was the McDougall report in 1976. And these reports all studied federations like Canada and Australia and the US to try to work out what was required for a federation to be an effective system. And the sort of things that they recommended in each of their reports were that you would need a federal fiscal capacity, so a European finance minister, member states would have to devolve their fiscal capacities that they had to this federal body, and would have to have a sympathetic central bank at the federal level, which work together like central banks and treasuries work in effective federations, and that for political legitimacy, that you would have to embed that economic and financial structure in a democratically elected governmental system. And Werner report fell by the wayside because the French and the Germans could never agree. And the McDougall report went a bit further and said that, in their view, the essential requirements for an effective federal system in an integrated monetary and economic system, a common currency, the essential requirements to make that system work wouldn't be found in the foreseeable future in Europe, given the Franco-German rivalry, given the different cultural circumstances across the space, given the different languages across the space, and more important, and most importantly, not more, most importantly, the vastly different structures between the various member states in terms of their economies, in their industrial structures, their export strengths, and all of that. And so for all those reasons, the integration just kept bumbling along the debate, but not much progress. Now, then you get to what changed was the rise of monetarism in the academy, which spread out from the English-speaking world, the US English-speaking world, spread out into central banks, into treasuries all around the world, spread into through the academy, and changed the dynamics in Europe quite considerably. And one particular dynamic that changed was the balance of power in the French ministries, because up until then the planning ministry was more powerful than the finance ministry. And the planning ministry had come out of the Second World War period and were very Keynesian and socialist in orientation, whereas the finance ministry was much more free market, and I'm using terms very loosely here. And what changed was that the finance ministry, monetarism started to move into all of the policy bureaucracies, and the finance ministry started to become dominant. And so you had the sort of massive shift in 1983 with the Mitterrand government, the so-called austerity turn. You had Jacques Delors in 1983-84 adopting for the first time the concept of Francfort, the strong franc, and that really started to align the French policy thinking with the German policy thinking, the Bundesbank thinking. And of course, what happened then was Delors moved into the commission as president and set up his committee. The committee was structured very carefully by Delors to exclude all finance ministers. He only really had central bankers and some conservative economists on that committee. And because he knew that he wouldn't be able to overcome the endemic Franco-German rivalry if he had them on his planning committee for integration. And the way in which Delors came up with an appeasement strategy to bring France and Germany together onto the same page was to tell the French that they wouldn't have to cede their national economic prerogative. So there was all this debate about subsidiarity, if you understand that, and I haven't got enough time to go into it tonight, or today for you. But this is this idea that you locate responsibilities at their best place, and Delors revved that up so that the French would, who still held views that they weren't going to cede any significant power to Brussels, and he was able to appease the Germans by saying that, yeah, we're going to leave fiscal responsibility at the national member state level, but we're going to put a straitjacket on them through the fiscal rules. And if you know your history, you'll know that Theodor Weigel was the German finance minister in the 90s, and his initial proposition was a stability pact. It wasn't growth and stability pact at all, it was the stability pact. And that was sort of the German Bundesbank type obsession about currency and inflation. And so what you ended up with was a system out of Maastricht, and then once the annexes were all determined and the convergence process, what you ended up with was an austerity machine, a neoliberal machine that was straitjacketed, that didn't have the essential characteristics that a functioning federation has to have, and had such tight constraints on the flexibility of the member states that they were in a bad external shock. They wouldn't be able to respond. Now, one point to note about that before I finish my last section, which is on future prospects, even with the 3% fiscal deficit rule under the Stability and Growth Pact, which has been sort of hardened under the Fiscal Compact and the Six-Pack and all of the rest of it that was embedded in the financial crisis. Even with the 3% rule, that's a fair amount of flexibility. And because in typical times, a currency issuing government doesn't have deficits bigger than that anyway. And so even within the straitjacket, there was some flexibility. And what's really significant was during the pre-GFC times, most of the governments didn't use it. And that's because they were imbued with the sort of growing monetarism, neoliberalism, whatever words you want to put on it. Now, of course, during the GFC, even just the cyclical effects, the automatic stabilisers, blew most of the deficits beyond the threshold anyway, and triggered the surveillance criteria, and the austerity machine went into on steroids, and dreadful damage caused to citizens' prosperity as a consequence, more so in the south than the north. But that's the consequences of that architecture. It's biased towards austerity. It can't support sustained prosperity in meeting the fluctuations that economies face over cycles. So what are the options? Well, the options are quite clear. The options are you continue as, and at the moment the rules are suspended under the emergency conditions. And I note a lot of progressives are saying, oh, well, that's good, we won't go back to where we were. Well, don't bet on it. I believe that the excessive deficit mechanism is about to be unleashed, and that's when you'll start getting punitive action again. And even with this suspension of rules, most of the governments have restrained their stimulus spending in the face of the pandemic, because I think their psychology is that they're scared that if they exceed the limits by too much, the long arm of the excessive deficit mechanism will be very harsh and cause them much more grief than they perceive they've currently got under the pandemic. That's conjecture. But I don't think you should be in any doubt that the European Commission will rev up the excessive deficit mechanism anytime soon, very soon. And the point is that so you could just continue as before, and you will continue to fall behind the rest of the world, and be biased towards austerity. You could go the Verner McDougall way and create a proper federal system. Now, the sort of current Euro bonds that have been grudgingly accepted are not what I mean by a federal system. Most of the current Commission support is in the case of loans, not grants. It's not a federal system at all. So you could go to a proper federal system, but I don't believe anytime soon, in the foreseeable future, the politics, the cultures will allow that. I don't think Germany will ever allow that. And so I don't believe that's an option. And the third option, obviously, is orderly dissolution of the Eurozone. That's the preferred one in my view. The organisational units like a European Union have a purpose to deal with issues, as an organising unit, to deal with issues that are beyond the capacity of a single member state to deal with. I'm thinking climate change, I'm thinking immigration, I'm thinking rule of law issues. And that sort of structure could benefit Europe into the future, be an extremely effective organisation based upon intergovernmental agreements like the old Commission was before the Maastricht Treaty. And then let the governments, the member states, have their own currencies back, and let them float those currencies, and let them get on with defending the public interest as they are democratically elected to do. Because at the moment you don't have that. You have a democratic deficit where you've got technocrats at the Brussels level marching into treasuries around the space, around the European space, ordering governments what to do. There is a democratic deficit. The people aren't being served by their member states well, and there's no solution to that within the current structure. So I think I'll leave it there and hand over to Heikki. Thanks very much.
Thank you very much, Bill. Just before we unleash Heikki, I think we have a few questions, or what do you say, Nina?
There's actually just one question before we unleash Heikki. So from Jussi, Bill, can you explain how the government spends, so the institutions involved, and what happens in the central bank? Also explain what happens in the central bank when tax is collected. Thank you.
Well, I mean, these are institutional structures. Intrinsically, how governments spend in a fiat currency environment. Now, remember that in August 1971, the monetary systems in most countries changed dramatically. We moved from a convertible currency system where currencies were ultimately pegged to the value of the US dollar, which was then pegged to the value of gold. We abandoned that system mostly. Europe didn't, but we did. Most countries did. And we went into what we call the fiat currency issuer, where the currency isn't backed by any valuable commodity. And so in that type of system, the demand for the currency is driven by the fact that the government has a legislative right to demand that currency to resolve tax obligations, and that's what gives the currency its legitimacy. Now, in that context, in a fiat currency system, the way in which governments spend is to type numbers into bank accounts. So in Australian sense, the Treasury instructs the Finance Department to instruct the Reserve Bank of Australia to credit bank accounts according to the procurement contracts or the welfare payments that the government wants to make. Now, obviously, the same type of arrangements work in the Eurozone, for example, but the constraints on that process are different, as I explained. Now, how it actually works in each country, it depends then on the institutional and accounting structures that the various governments put in place. And, you know, they can be as complicated as you like. And where people get confused is into thinking that those accounting structures are actually intrinsic constraints. So what I mean by that is, in Australia, the federal government has a bank account with the Reserve Bank of Australia, and the Australian Tax Office issues tax debts, and they get paid into an account at the central bank. And of course, when the government issues debt through the Australian Office of Debt Management, that those funds go into a bank account in the Reserve Bank, and the accounting makes it look as though the government spends out of those accounts, which then people say, oh, see, the tax revenue is the spending. But that's just an accounting illusion. And the reality is that the federal government of Australia just types numbers whenever it wants to into bank accounts, and the spending is done and funded at that point. It wouldn't have to have any money in the tax accounts to do that. And so these accounting arrangements are just really smoke screens. Now, it's different for a member state in the Eurozone because it can't spend in that way. It has to have debt funding or tax revenue because it doesn't have its own currency. And ultimately, if it started typing numbers into bank accounts without being covered by prior reserves of euros, then it could quite easily run out of euros. Whereas that can never happen to, say, the US government or the British government or Australia or Japan. Okay.
All right. Thank you. It was very clearly answered. I'll add Heikki to the screen and just quickly show our schedule today. Let's see. All right. Well, the schedule is that next we have Professor Heikki Patomäki to give a speech or a lecture about the currency arrangement, and I think we're dreaming of a better currency arrangement or a perfect currency arrangement in the Eurozone. What do you say, Heikki? Not sure we can hear you.
Oh, sorry. Now you probably can.
Yeah.
I'm not sure that that's the right question to ask, as I will explain shortly. But thanks, Bill, for a very enlightening lecture. And I will continue from there. I will start by sharing my screen. Just
problems?
a second. Screen 2. Now I hope you can see it. Can you?
Yes. Thank you.
Okay. Thank you. So, dreaming of a perfect currency. That's the overall title. I will first argue this is kind of a prologue to my discussion. That in fact there is no perfect currency, and this means actually two things. The first is that any currency is a form of money, and to describe money as perfect in some sense is somewhat misleading. There's this famous the passage in one of the plays of Oscar Wilde, where Cecil is asking, "What is a cynic?" And Lord Darlington then responds, "A man who knows the price of everything and the value of nothing." And this is very often used as a kind of a description of mainstream economists, the way they think about the world. There's of course this counter that and a sentimentalist, my dear Darlington, is a man who sees an absurd value in everything and doesn't know the market price of any single thing. So even though money might have a place in complex modern societies, it has been a traditional aim of the left to decommodify social relations. So in the socialist or social democratic tradition, the idea of decommodification means to reduce the role of money and markets in social life. So that's the first meaning of there being no perfect currency. In the second meaning, which is much more general, there's also a point in saying that social life tends to be dilemmatic, which means that there are always dilemmas in the processes of emancipation or attempts to improve the society. So the point is that while society can be improved by reducing its illusions, contradictions, violence, injustices, and so on, many apparent solutions in fact generate new problems. So this is the starting point.
Sorry, Heikki. We were just thinking if it would be better if you had the full screen effect. Now it's a little bit small.
This way around?
That's great. Go ahead.
Okay, thank you. Sorry about that. It's very difficult to tell how these systems work. I mean, sometimes they work the other way around and sometimes this way around. Anyway, so after this prologue about the perfection of currency, let me start to discuss the EMU itself. And I'm aiming at this kind of a simple table, where we have two different economic theories and two different theories of legitimization or legitimation. And then we can interpret the prospects of the EMU from this perspective. But let me first try to explain these categories very briefly, starting with the theories of legitimacy. And these theories are of course complex, and there are many theories, but here I'm using or relying on two ideal types. One is the Schumpeterian, very pro-capitalist theory of legitimation, if you like, where the idea is that efficient production of goods and services, protection of private ownership, and the freedom to choose on the market are sufficient for legitimacy, only provided that liberal human rights are guaranteed and that political leaders can be periodically changed through elections. So that's a kind of a minimalistic interpretation of democracy and democratic legitimacy. I'm using the name of Jürgen Habermas to describe the other ideal type, according to which the normative justification of political rule is much more demanding. It requires ethical political meanings that are significant to us, including all kinds of stories that give meaning to our lives, human development, social justice, and most importantly, perhaps, citizens' active participation in democratic practices. So the argument being also that in empirical historical terms as well, this tends to be a condition of factual acceptability of a rule. Although it is also true that many systems, political systems that is, have existed extended periods of time without having this kind of a basis. Okay, so we have two ideal types for understanding legitimacy. And similarly, to simplify grossly, there are two categories of economic theories here. The first is the liberal economic type of theories based on microeconomic models of equilibrium, on the idea that markets are efficient, and on this basis, to make it as simple as possible, also the basic neoclassical macroeconomic doctrines follow. Of course, there are all kinds of variations here and there, but this is the basis to make it as simple as possible. And implicit in this idea, there's also this notion that market prices are not only efficient in some sense, but also just. This justice can involve simply the notion of Pareto optimality, but very often there's this idea that the markets guarantee that the factors of production, their marginal productivity is equal to their price in the market. And this actually amounts to what can be called scalar model of justice. So free markets ensure not only efficiency, but also justice. Post-Keynesian and post-Kaleckian theories, they have a rather different starting point. The idea being that the capitalist market economy is in many ways unstable, so the feedback loops are not based on just negative feedback, but also on positive feedback, meaning that the many processes are self-reinforcing. And this applies also to processes of uneven growth and growing inequalities in society. So they involve self-reinforcing tendencies. So here we have the four possible interpretations based on these ideal types of the EMU, its prospects, and also around the or related to the politics of the EMU. So in the first category, what we have is the idea, what we can call neoliberal economic theory combined with the minimalist understanding of legitimacy. And there the idea is that Maastricht Treaty is firmly founded, the EMU is legitimate and functional. From a more critical legitimacy perspective, Habermasian, if you like, the idea might be, or the implicit assumption might be, that the EMU somehow works, but its democratic legitimacy is very fragile and unstable. In the third category, when we apply post-Keynesian economic theory, but are still content with the minimalist theory of legitimacy, we can see that the understanding is that the Maastricht Treaty is unstably founded, and the EMU is likely to strangle Europe and is also prone to crisis. If you combine these two different perspectives, as I think both Bill and I do, the Maastricht Treaty is seen as crisis-prone and undemocratic, and in many ways unjust. Likely economic crisis will sooner or later destroy its legitimacy. Well, does this imply anti-EU stance? It doesn't. The Euro memorandum or Euro memo group is a good example of a pro-European Union association network that has been producing annual reports, annual memoranda for 24 years now. And these are a couple of quotations of the first one. I'm currently a vice chair of Euro memo. In the beginning of the report, the problem was described as follows, and this is certainly quite adequate in 25 years later. In the absence of an effective employment policy, poverty and exclusion in the EU are further increasing, exacerbating economic and social divisions, making for polarization, leading to more inequality and injustice in society. This pattern of development also threatens political stability and democratic structures, and most importantly, perhaps in some sense, gives rise to xenophobia and increasingly virulent Euroscepticism. So quite accurate. And then in the same report toward the end, there are many reform proposals. One of the possibilities that is being discussed is central bank funding. Here's another direct quotation. The argument on low interest government borrowing from national central banks also applies to the EU level and the ECB. There is no sensible reason why the EU shouldn't have preferential access to the European Central Bank within the framework of a comprehensive, transparent, and well-targeted employment strategy. So as you can see so far, there seems to be full agreement with MMT. MMT is a post-Keynesian economic theory, and it also involves a commitment to democracy, not necessarily at the level of economic theory, but for instance, if you read Bill's and Thomas Fassi's book, Reclaiming the State, there are strong arguments against depoliticization and in favor of popular democratic mechanisms. So in that sense, one could argue that there is a kind of a Habermasian way of thinking about democracy as well. And personally, I also agree with some of the basic thrust of many of the ideas of the MMT. money is a social construction, and in the modern capitalist market society, it has been created largely by the state, although there are exceptions and other cases as well. There are also examples of commodity money, but mostly this has been the case. It also makes a difference whether public authorities take debt in their own currency or in external currencies. So the situation in the Eurozone is in that regard rather ambiguous. And I also agree that the Apollinairian functional finance is possible, at least to a larger degree than assumed by orthodox economists and also by quite a few Keynesian and post-Keynesian economists, including Keynes himself, who seemed to be quite ambivalent about the possibility of anything like functional finance. Let's then speed on to the current situation. And Bill already mentioned the beginning of the era of fiat money, proper fiat money after the Bretton Woods system eroded or partly collapsed in the early 1970s. There has been a situation where the money is not anymore backed by any valuable commodity. Moreover, during the past 10-15 years, especially after the global financial crisis, what has emerged is unconventional monetary policy. Of course, in Japan, there's a longer-term experience about this, but after the global financial crisis, the US Fed, and a bit later, the European Central Bank, and a number of other central banks in the world have followed policy lines that seem to be giving credibility to the basic ideas of MMT. But of course, in this context, it's also quite interesting that the European Central Bank is also following suit. So this seems to give some plausibility to the basic theoretical ideas, at least to a certain extent. Of course, the interpretations and meanings and implications of all this are very controversial. On the right-hand side, I have a quotation from The Economist in 2019 from an article that actually discusses modern monetary theory. It's a good, important quotation in the sense that it recognizes two things, that the macroeconomic theories deal with open systems and the laboratory experiments are not possible, so we can't have decisive tests in favor or against any particular theories. And secondly, that the prevalence of particular theories or hegemony, the hegemony, is a matter of power relations. And this is quite important to understand, that there's no way, unlike in laboratory experiments in natural sciences, to create a decisive test between economic theories. There's certain uncertainty about them in any case. Now I take up a couple of problems with the MMT type of interpretation of the EMU. The first concerns the underlying political theoretical assumptions, namely concerning democracy. And there's a tendency to connect democracy essentially to national states. And then the second part of the interpretation is that international, multilateral, and supranational institutions are only seen as being used to roll back democratic achievements within national states. Well, to a certain limited degree, I think that both can be seen as partly true. And the latter has been the case, especially during the neoliberal era. And if you read, for instance, Quinn Slobodian's book, Globalists, you can see how this idea of actually using like international law and near-constitutional means to lock in the basic ideas of free markets internationally or globally that emerged already after the First World War. So there's a long history, that idea, and certainly it describes at least some of the developments during the past 30-40 years. But nonetheless, as generalized or essentialist claims, they tend to be misleading. And thinking about these two assumptions, starting with the first one, if you think about states and democracy, First of all, a liberal democracy or any form of state democracy is in fact a very recent historical phenomenon. Before the 20th century, hardly any of these kinds of states existed, and even in the late 1930s, in the 1940s, there were only about a dozen of liberal democratic states in the world. So this is a fairly recent phenomenon. And most states in the modern era, including in the 20th century, have not been democratic in this sense at all. Secondly, many international, multilateral and supranational institutions in fact aim to establish and spread national liberal democracy further. And this also is the case for the EU as well. And in fact, if you read, for instance, international law, there's a big debate about whether there's a universal legal norm on democratic governance, like there might be concerning certain human rights, for instance. And particularly after the end of the Cold War, but this still continues, there have been various processes through different international organizations to further democratization in different places. This can be critically analyzed, but nonetheless, it doesn't annul the idea that the international, multilateral, and supranational institutions can be also pro-democratic. Secondly, some of the economic theoretical generalization of MMT can be problematized to a certain degree with regard to the growth theory and this inflation and so on and so forth. I don't think that is something that we need to discuss here in this context. But what is important is the role of social structures in determining investments, and which is very much part of the overall picture, and how that is in turn connected with the positioning of a country in the worldwide division of labor and in the processes of the world economy. And these in fact largely determine the powers of its money issuance. So it is not something that is independent of the world economy, its processes and structures, but rather is essentially connected to it. And very often some of the stronger claims of MMT seem to be based on the possibilities that are limited to a couple of possible actors, and sometimes especially to the United States of America. Now, assuming a slightly different angle to the problematic, think about the politics of scale. At what scale should we realize something? What is the right institutional level? And then what kind of strategy should an entity adopt in terms of positioning itself in the world economy? Now, the case of Brexit is telling, I would argue. And you may know that there were like two different possible versions, soft and hard Brexit, and then left and right versions of both. And these involve different ideas about the relationships with the EU after Brexit, what should be done, and then also with regard to the wider positioning of the UK in the world economy. So even though the reality tends to be complex and these pure categories don't exist in the real world, there might be elements in combining aspects of some of these in the current situation. But it seems to be that this possibility is the one that is dominant in the UK approach to Brexit. So instead of using the regained autonomy to rebuild democratic welfare state, etc., they are trying to exploit maximally the UK possibilities for benefiting from tax and competitiveness war against other states. In fact, thereby deepening neoliberalization in the world economy, in the world political economy, which I think is somewhat problematic from the point of view of democratic and social aspirations that many on the left especially have. We can also have a look at the historical perspective, a historical look at the left options here, and the UK positioning in the European Union politics in particular. Margaret Thatcher was very skeptical of EU federalism. She advocated enlargement to the east after the end of the Cold War. But I mean, this famous speech in 1988 is particularly revealing about the UK position at that time. She argued in that speech, "We have not successfully rolled back the frontiers of the state in Britain, only to see them reimposed at the European level, with the European superstate exercising a due dominance from Brussels." So what the UK did by opposing EU federalism and then also advocating enlargement to the east, knowing that the Eastern European countries are deeply committed to neoliberalism, anything that was categorically opposed to the Soviet style of socialism, the historical role of the UK was in effect to make the EU as neoliberal as possible. Then at the time of the 2016 referendum, just before it, but also in its aftermath, the British left was quite divided. And the debate concerned first and foremost about the extent to which different EU agreements and systems are compatible with the attempt to develop political and social democracy within the UK. So what the anti-EU left in the UK was doing was to blame the EU for something that was to a significant degree a result of the past UK policies, which is quite paradoxical, but it's also telling about the inherent possibilities of transformation within the Union itself. So politics of scale matters, positioning in the world economy matters. And and from this perspective, I can make a more general point as well. Namely that the idea of public money creation is not intrinsically linked to a single nation or state. Money is both an institution, social institution, and a form of power. And it's power in the real sense of capable of doing things. I mean, it has generative power in that sense. But it's also heavily involved in relations of power in society, also in the sense of domination. And this power can be organized on many levels, and at each level, more or less democratically. If you think about the notion of sovereignty, let me put it this way. The ability to create money is linked to the notion of sovereignty only in a very contingent way. In international relations, in law, in the many practices, sovereignty simply refers to legal hierarchy. The term comes from the word super, meaning something that is above, and the idea has been since the early modernity, when the sovereignty was the same thing as the monarch, that there can only be one supreme sovereign in one territorial area. This was a long development in the European history, and then it was later globalized through the expansion of the European international society and capitalist market world economy. But this is the meaning that still plays a major role in international law and international practices. The concept is very paradoxical. It is divisible and indivisible at the same time. It refers to internal authority, but actually requires the recognition of other states and so on. But the point in this context being that sovereignty in this sense, which is the normal sense in law and international relations, is not connected to any particular institutional arrangements about money, for instance, floating exchange rates or anything of that sort, but is something that is more general. And in terms of sovereignty in this sense, we can actually distinguish between various sovereign and non-sovereign ways of organizing the public issuance of money, and at different scales. So think about unitary state or nation. Finland was a kind of a unitary state and nation since the independence in late 1917, particularly after the Civil War in 1918, until 1999, when the euro was introduced as as currency. The actual physical notes came in 2002, but the euro was introduced in 1999. But also many contemporary states, for example, just to take two examples, Egypt and Japan. Then we have wider regional federations and large-scale communities like Australia, Brazil, United States, India, and China. And we can also at least imagine or think about the possibility of a world state or world scale sovereign issuing money. But we have also various non-sovereign arrangements. Think about Finland before 1917. It had its own central bank and its own currency, but was part of the Russian Empire. Of course, Finland was in the gold standard, and there were other constraints as well. But nonetheless, I mean, it was a very interesting experiment from this perspective. Finland was not a sovereign state, but nonetheless had its own central bank and currency. The European Union is also a non-sovereign way of organizing money issuance, and in terms of scale, it's somewhere between Australia and China. It's comparable to Brazil and the United States in terms of land area or population, or the GDP. It's smaller than in terms of population than India or China. It's only 25-30% of the size of those countries. And then there are non-sovereign ways of organizing money issuance also on a global scale. For instance, the Keynesian original proposal for international clearing union, developed by many since then, Brandt Commission, Paul Davidson, but also Joe Stiglitz, who explicitly takes up the idea and the possibility of money issuance on a global scale. Which leads me to see all these combinations as possible. You can have a national currency with neoliberal policies. You can have European currency with neoliberal policies, but you can also follow what could be called, I mean, whatever that more precisely means, post-Keynesian policies at the level of national state or at the level of European Union. And it is also significant in that context that currently the European Central Bank provides de facto preferential lending to the member states, and in effect it has also helped to organize the European-wide COVID-19 package as well. And from this perspective, I'm coming to the final part of this talk. There are some paradoxes of left politics with regard to the European Union. And my argument is that the EU critical left is in fact helping to maintain the neoliberal EU as it stands today. And this happens through essentialization. By seeing the EU as essentially neoliberal, some parts of the left, of course they are opposed to neoliberal policies in Europe, but nonetheless, will in their part help to ensure that it also remains so, that is as neoliberal, because they refuse to support any further move in post-Keynesian or democratic direction. And this is very easily becomes a kind of a self-fulfilling prophecy. Of course, this left has only a relatively small political role in the European Union today. But this small role can nonetheless be significant to the extent that this division within the left makes it much more difficult to support the transformation of the European Union. And paradoxically then, the anti-EU left in effect seems to be complementing the project of Margaret Thatcher. The second paradox is different though. Assuming that the federalist project succeeds, at least to some degree, it may in fact transform the European Union into another sovereign state within the state system and capitalist world economy. And this is something that people like Johan Galtung anticipated already in the 1970s when he published this book, The European Community, a Superpower in the Making. Very much worth reading even today. And from a globalist perspective, I'm a globalist, this is a problematic direction. And it's related to the point I made in the prologue, that the social world tends to be dilemmatic. I don't think that the EU is a sufficient solution to the aporias generated through the political economy of scale. And indeed, there is no perfect currency. And the euro is not the perfect currency in the world. And when we look at the real world examples from a global perspective, we can see many problems that might be created by a federal European state. But the same holds true also for nationalistic approaches to the current problems that we face in the European Union. It can have all kinds of unintended consequences. It's like playing with the fire. Even if you are not a nationalist yourself, by supporting those kinds of movements and ideas, making them as the kind of a natural way of approaching the problems of the world, it tends to reinforce nationalistic movements as well. And I think that sort of disintegration or disintegrated tendencies into global political economy are highly problematical. So we have to think about emancipation as a historically situated possibility within the real world historical processes. And when we are thinking about what is the right direction, we need complex arguments and related judgments. We have to analyze the ongoing processes. We have to analyze what is rational, also normatively at this point in time, what are the true explanations, and then also propose various possible concrete utopias. I mentioned these different scales and levels, and as far as the global models are concerned, they seem to be non-existent, but there is already a form of existing global currency issuance or money issuance as well, namely the International Monetary Fund's SDRs, special drawing rights. They are units of account for the IMF. The same would have been true also, or would be true for Keynes's bankers, but they can be exchanged for currencies. In that way, money can be created through SDRs, and they were in fact created, even though only to a modest degree, during the global financial crisis, at the level of 200 or 300 billion US. So, in conclusion, my argument is also that global problems require global solutions. I'm again making a reference to the International Clearing Union idea. The point is not to say that we need only global solutions. We have to think about the solutions in a contextual way, and the world, the governance of the world economy in terms of multi-scale and multi-level systems of governance. So we have different possibilities there. But I want to conclude by stressing the importance of the global level. And the Stiglitz version of the ICU plan is particularly interesting because it explicitly considers the possibility of money creation on a global scale in order to be able to tackle two key problems of the world political economy, namely climate change and poverty. Both are global problems. However, as in the final bullet point say, many other solutions are needed, including global taxes and public investments. Thank you.
Thank you very much, Heikki. Was interesting to hear different ideas and also a little bit of critique to the MMT idea. I'm interested to hear you discuss this in the panel. But now, Nina, do you have questions?
Actually, there's just a couple of questions to Bill, so I'll present them at the audience question part. But there is a question. May you share the slides later? So is it okay for us to share them with people?
Yes, of course,
Great.
All right. Now I'll add Bill and Ari to the screen, and Ari will host the panel, and we'll take it on from here. Go ahead, Ari. You're muted still, Ari.
Yes, thank you, Konsta. So just a So first of all, thank you, both of you, Bill and Heikki, for your very, very interesting and thought-provoking presentations. And I just also say a couple of words of introduction of myself first. So hello, everyone. My name is Ari Slioor, and I'm the also a member of Talousdemokratia, which translates into English as Economic Democracy Finland. So that's the organization that I and Konsta both are from. And I'm the vice chair of board in Talousdemokratia and also the international representative. And I will be, yes, moderating the panel today. So, yeah, a couple of comments first on your presentation. So, yeah, they were, I think, very, very interesting. I thought provoking, as I said. And then what I found really, really interesting and crucial and important is the historical perspective. You both referred to the history of how the current European economic and monetary came into existence, and I believe that is always very crucial in understanding where we are now, and also in trying to figure out what is realistic in terms of where we could go from here. And in terms of moderating the panel, I want to say that I just can think of so many questions on so many different aspects and approaches and everything that I could speak here for, I don't know, 8 hours at least. So, but I need to make really some kind of hard choices of how I'm going to choose what to ask and how to moderate the panel. So what I thought that I would do is that I will try to focus on actually on thinking of all of these things that we've discussed today and you've said in your presentations from the perspective, first and foremost, of actually the political realities of where we are at the moment and how to move forward, what would be possible and what would not be possible, and so on. And also, since the Rethinking Economics is an organizing organization as well, so because they, of course, what they are aiming to do is to pluralize the teaching of economics and so on. That's a central thing for them. I will also briefly, at least, to try to discuss something related to the economics as a discipline and how it's taught at the universities. Because so actually I will begin with that. So what was really clear from both of your presentations is that economics in itself, you cannot have kind of economic theory that in practice, or at least you cannot make propositions for economic policies that would not be somehow political. There's a political ideology always somewhere in the back of people's head when they think about these things. And I think that, and if you disagree, please correct me, but that's what I thought, how my interpretation of your presentation was, that the political aspect is in a way inseparable in practice, are suggested and so on. And you talked about the neoliberal structures of the European Union and the economic and monetary union and all of these things. So actually what I would want to ask then is in terms of the discipline of economics. So how could you actually introduce pluralism, and how could you, because in Finland, for example, here, I actually spoke with a person from Michal Kumhoff last summer, who is actually a year ago, who is a researcher at the Bank of England. And what he said is that he once visited the University of Helsinki economics department, and he told me that, yeah, it's so over the top neoclassical. It's like there's nothing else there. And I think that you both are very strong critics of the neoclassical approach. So what would you think that, how could that actually, can we change that? Is it true, in your opinion, that it's over the top neoclassical at the University of Helsinki? And what could we do to change that? And can we actually make some of these things of modern monetary theory, for example, of other aspects, other types of schools of economics, can we introduce that into the University of Helsinki economics teaching somehow?
Okay, should I start?
Okay, Bill? Please go ahead.
I would like to share another thing, if that's possible, to show the variety of economic theories that there are. Where is this now going? Share screen. Now you should be able to see it, I hope. And then the other way around. Well, this is an attempt to tell what kinds of theoretical approaches there are in economics. If you look at the variety, we have neoclassical economics here, then we have Marxian, Schumpeterian, Austrian, institutional, evolutionary, feminist, and post-Keynesian. So in my presentation, I was basically referring to post-Keynesian only. But in fact, I find all these relevant and interesting and important for some purposes and in some regards. None of these is being taught at the University of Helsinki economics, the department or whatever the economics curriculum. And it's basically the shift in neoclassical consensus, with some elements of radical reinstatements of free market orthodoxy, like the rational expectations, monetarism, and so on. And then there might be in macroeconomics the elements of new Keynesianism, not really Krugman and Stiglitz, they would be too radical for these people, but I mean new Keynesianism in the main textbook sense of the term. Behavioral economics might be mentioned, game theory is studied by some microeconomists. So it's basically the approach in Helsinki economics, the department is limited to the mainstream neoclassical economics. None of these other approaches is being taught in any sense of the term. So that's my impression, and it's quite important to also stress the plurality of different approaches. So even though in my presentation I simply made a distinction between neoclassical and post-Keynesian, in fact there are also many other interesting approaches as well.
Okay, Bill, your thoughts?
Well, I mean, the very reason that I'm here and that I have a alternative title, docent professor in global political economy at the University of Helsinki, is because of the vision of Heikki and his team to expand the economics curriculum outside of the formal economics department within the political science area of the university. So that's the first point I'd make. When we think about pluralism, it's a really interesting thing, progressive, and I call heterodox progressive. So that's just a nomenclature type thing. But when progressives talk about pluralism, and I think this applies to the debates in Rethinking Economics, the group, I think I run a little bit counter to what that narrative is, and I'll explain why. I think being exposed to a wide variety of intellectual traditions is very important for a student and for a teaching program. Now, is that pluralism or not? Let's park that question for a moment. But there's no place in a university system, wherever it might be situated, to teach fiction as knowledge. We have a concept of knowledge, I think, and it's rubbery and it's fuzzy around the edges, but I think we have a concept of knowledge. And I think when we left the flat Earth theory of geography because ships came back around the other side. And so we replaced a perception of knowledge and called it anti-knowledge, and then reframed that as knowledge globe. So I think there is a tradition where paradigms are exposed and revealed to be, first of all, degenerative in the Lakatosian sense, but also then, in my view, they become non-knowledge. And I think, you think about, Heikki mentioned New Keynesian economics, which is the dominant macro at the moment. Well, that's not even macroeconomics. Because if you think about what it is that it's a paradigm that's derived from microeconomic optimizing principles that then stumble to have anything to say about the aggregate, which is the macro level. And to overcome that, they introduce a representative agent, whether it's a consumer or a firm, and they make assumptions as if they are individual consumers or individual profit maximising firms. And so they're not even, and when they have to talk about macro, they can't possibly apply the optimised micro-founded model because it doesn't work. So once they get into the empirical domain, they add lags to their functions and all sorts of things that are optimization exercise could never produce that form. And in other words, they are non-knowledge. In my view, new Keynesian economics is non-knowledge. And so therefore, it doesn't belong in a pluralistic agenda. And for example, in our textbook here, which Heikki kindly launched for me in London a few years ago, we treat what we call mainstream economics as history of economic thought. And I think that's the appropriate pedagogy, that it's been an important part of our intellectual tradition. And students should understand that in a historical sense, but not in an analytical sense. And so that's what I think about pluralism. Now, the last thing I'll say is that a lot of the things that were on the bottom tier of Heikki's last table are incredibly important parts of the jigsaw puzzle of being what I call well-read. And you know, I've just finished writing about Marx, about how I was at a panel last Sunday in the UK where a Marxist said that government spending would never create more employment. Well, you know, that's a very extreme interpretation of Marx, and it's certainly not the one that I've ever had, and I've read everything Marx has written, I think, that I could get my hands on. And so, you know, the understanding Marx in an intellectual way is important, not a doctrinaire way. Understanding what the feminists are talking about, and even understanding what the Austrians talked about in terms of, you know, the famous calculation debates with Oscar Langer and that. Very important for us to all understand. But we can't, in my view, have programs in macroeconomics where you teach students non-knowledge. That's false, and I reject that outright.
And I agree with Bill that not as an echo.
Okay. So just, do you have, if you want to say something, Heikki, on this, on like 2 sentences? But I think we want to move to a different theme. So if you, just a few words, if you want to still add something.
Yeah, just to reinforce the idea that the pluralism doesn't imply relativism. You can still make reasonable judgment about whether a theory is realistic, plausible in terms of evidence and so on.
Mm-hmm. Yes. So, and thank you for this. And this was really, I would say, thought-provoking. Definitely, I mean that neo-Keynesianism would be Keynesianism is non-knowledge. So that's something for the economists to think about. The reason that I wanted to ask this also is that because here in Finland, in the public debate, in the media, for example, often even journalists, they call these experts on economics the wise men of the economy or something like that, the scholars. Okay, it's in Finnish, but I think that the kind of nuance of the terms is that we have some kind of wise men of the economics, and then they know how it is, and the others don't, and we just need to listen to them and so on. So I think that in general is problematic, and that's why I wanted to just throw this out there, that actually we don't. I think it's false to say the wise men of economics, in a sense that we would actually have someone, because it implies that they know everything or something. So that's just something that I wanted to bring to the actually there are many different views on things. Yeah. Okay.
Just add one point. What we are trying to do in Helsinki, this global political economy program, is precisely to educate alternative kinds of experts who can actually say things about the economy in a realistic way.
Mm-hmm. Yeah, and so good luck with the projects. But anyway, yeah, this is something that I just wanted to bring up. I think we need to move on to more practical things, because I think a lot of the audience is probably interested in the political realities of the European Union at the moment and so on. So let's move on to those topics now, and actually still kind of bridge to that through the theory in a sense. One important thing that I think you both kind of mentioned in your presentations is that, Bill, you said that there are no financial constraints for according to the modern monetary theory for a state that has currency is sure, and that there are no financial constraints in how it can buy things that it can buy where the price is set in its own currency, or it buys with its own currency. And I think that Heikki, you also mentioned this in a way, but now because Heikki, you criticized this, and I think that what you thought, Heikki, is that there actually are more constraints than it might might be implied by what Bill said. So actually, my question now is that often the criticism towards MMT, the modern monetary theory, is that it's basically based on the idea how the United States dollar works, and so that's a criticism. And Bill, you can also I can see you shaking your head, but that's a criticism that I've often heard. That the criticism is that actually, of course, the United States, because it's a reserve currency, you can buy things always in the United States dollar. So that means that you don't really have financial restrictions on the international markets. For example, when you want to buy raw materials or whatever products. So what do you think on the fact that if, for example, because Bill, you're suggesting that that we should dismantle the euro basically as a currency. So now we're in Finland. So to make this practical as possible, if the Finland were to return to its own currency, if we would have the Finnish mark, what would be the constraints for us to buy things in the international markets? Because things, are they priced in the Finnish marks or not? If they're priced in the dollars, are there restrictions, financial restrictions, in the sense of how to acquire raw materials and equipment and everything from the international markets? So what are your thoughts on this?
Well, of course there are constraints. The point I made was that within your own currency, there are no constraints. Once you have transactions between states, between different currency zones, then of course you've got to have something that the other zone wants. And of course, I often make the point that if you're what our work has shown, and going back to this point about it just being America, that's just a falsehood. I'm one of the co-founders, and I'm from Australia, and so it applies generally to all currency issuing countries. But that doesn't mean that all currency issuing countries have the same deal. And what I mean by that is, if you go to a very poor African state, and what my work shows is that state with its own currency can make sure that every productive resource that's available for sale in that country can be productively used. But it doesn't mean that country will be very well off. It may not have available resources that can make it as wealthy as Australia or the United States. And so then that country has an additional problem to transact. And that is that it has to persuade the rest of the world to give it extra real resources, and it has to provide the rest of the world with something that in exchange that will be attractive. So that's a constraint, no doubt about it. And in my writing, I've emphasised that is the legitimate role of a multilateral institution. We won't call it the IMF or the World Bank, something else that provides that global cooperation between nations to ensure that all nations have access to essential real resources for health and education and food and energy. That's the problem. Those countries that can't export and attract the capital and energy and food that they want, they're in real trouble. But that doesn't in any way violate the statement that I made, that a country that issues its own currency can buy anything that's available for sale in that currency. That's true also.
Well, we've been discussing this with Bill several times, and fully aware that Bill knows many of these constraints very well. I mean, there's no disagreement at that level, but our approaches might be somewhat different in methodological terms, because I'm not an economist, but rather a political economist in a different sense of the term. So when I'm looking at the world political economy, I'm always thinking in terms of processes that tend to go across the borders. I mean, the national state borders define the limits of national accounting within the borders, but not the real economic processes or social relations, which are have always been as far as the era of capitalist world economy is concerned, and at least since the Industrial Revolution, but way before that as well, worldwide. And each part of the world has been organized in terms of being a part of a much wider dynamic and evolving whole. And so whereas economics tends to start with the modeling one single country and then opening it up to various flows to the other parts of the world, my logic is different. I actually see the whole first and the parts only as part of that evolving whole. And so I'm looking at things from a slightly different perspective. And that also means that I see the constraints in a somewhat different light. I mean, we agree on many of these constraints, but the thing is that there are social structures that constrain the possibilities for investment within a country. If there's a conflict of income or wealth distribution that is totally unresolved in a country, money printing can simply be an attempt to overcome that, but very often tends to result in inflation. And so this is an aspect of it. And I also think that the state's capacity to tax is not only a matter of taking liquidity away from the circular processes of the economy, but is actually a way of ensuring that the state is legitimate and its currency is also credible, and that if it's lacking that kind of a legitimacy, those kinds of resources, it's incapable of taxing at a high level. It also means that it is constrained in terms of resources, independently of whether it has a central bank and its own currency or not. And that's quite important. And this is made more difficult, more severe because of these worldwide economic relations. We know that there are many processes that tend to reinforce the poor position of many countries in the world economy. The classical example being the terms of trade that tend to deteriorate for the poorer countries, relying on exporting primary goods and or the less processed goods or raw materials, for that matter. And there are many other long-term processes as well that tend to reinforce those kinds of things that then at the local level or global level, if you like, within the countries, also tend to reproduce relations of domination, social conflicts, and so on. So we are back to the question of whether the state is legitimate, can actually tax, and whether the money is used for investment or only for conspicuous consumption and those kinds of things.
Yeah, look, can I just make one quick point? No, that's all of that's, I agree with all of that. And one of the most important things, I've done work as a development economist in Central Asia, in Africa and elsewhere. And one of the things that always comes up when you're talking to multilateral agencies, I remember a meeting I had with the IMF in South Africa, in Johannesburg, was that a vital constraint on any government is its own quality of governance and its ability to maintain a rational rule of law. And once you start thinking in those terms, you realise a lot of currency instability, because you were sort of probing the issue about currency instability between countries, exchange rate instability. And Heikki referred to it really about legitimacy of state and ability to have a tax base. And a lot of that is to do with the governance quality. And that feeds into quality of your educational systems, your contractual certainty, the quality of your health systems, your skill development structures. And there's no, Australia has run an external deficit of 4% of GDP since the mid-70s. And we're one of the wealthiest countries in the world per capita. Now, how is that? Because we've got very highly sophisticated rule of law and the contractual certainty and education systems and all of that, which countries in Africa, for example, have not been able to get yet. And that's a major constraint on how that government can spend and what it can do with its spending.
Thank you. And I'm trying to push this into something a little more practical still. So taking into account those things that you said, and just a quick note on the use of time here, I would want to first, I ask a question where we would discuss the potential or the hypothetical situation where actually the euro would be dismantled and the European countries returned into their own currencies. So what that would then, taking into account what you just said, what would that actually mean in Finland? What the constraints would be, and how would that be different from the current architecture of the Eurozone? So that's what I'm planning to ask. So try to answer that, as briefly as possible, but still in enough depth if possible. But then I also want to, after that, talk about if we are talking about reforming the Eurozone, not dismantling it, but reforming it. And I want to also be able to discuss things related to that. But first, to make this as practical as possible, what would it mean for Finland, in your opinion, if we return to the Finnish mark as opposed to the Eurozone as it is now? And how would that affect the fiscal space, the opportunities, the constraints, and all of that? So try to answer this very briefly, but what would that mean? Because that's a debate in Finland at the moment.
Who do you want to go first?
Whether there's this kind of a debate, I'm not sure. But anyway, if you look at the history of Finnish political economy since the Second World War, what is interesting is that even though there was this process of building the democratic welfare state, and that implied all kinds of Keynesian or quasi-Keynesian stability, automatic stabilizers. And then there was the Soviet trade that also served similar function. But in fact, the Finnish state never applied Keynesian economic policies, counter cyclical economic policies. It never resorted to central bank funding, and it always was fully committed to the idea of balanced budgets. And in that way, the tradition in Finland has in no way been in accordance with the ideas of the MMT. Quite to the contrary. But because of the high levels of investment and the good luck also in terms of the trade relations in the Cold War context and other things, Finland actually succeeded in becoming a very affluent country and very egalitarian country also in world historical standards as well. And of course, there was a very strong left movement and supporting all these things. And then, of course, the unintended consequence of building the welfare state. But anyway, in terms of macroeconomic policies, and Finland has always been a very conservative country. And frankly speaking, I'm not taking any stand here on the likely consequences of disintegration of the euro, even partially, like thinking in terms of one country leaving the Eurozone. But just thinking about whether it would be possible to have a sort of post-Keynesian policies in Finland alone, I'm highly skeptical, to be honest.
Okay, Bill, your comments?
Well, I think what you're trying to tease out is a disaster scenario or what. And this is, the standard thing during the global financial crisis, particularly in relation to Greece and Italy, and Spain to some extent. Anyone dared to mention unilateral exit, and then there was going to be just a catastrophe for that country. And even on basic mechanics, financial mechanics, you think about a country, it's reinstating your own currency wouldn't be like leaving a peg. So when Argentina in December 2001 abandoned the US dollar peg, of course there were still pesos in the system, and that caused problems. That meant that financial markets could express their sentiment about that country by selling off that currency. And if you think about Iceland in 2009 and 10, it initially had a depreciation because there was currency in the system, because the hedge funds didn't like it imposing capital controls. But a country in the Eurozone now, it's not the same as going into the Euro as going out, because there is no Italian lira in the system anymore. There is no Finnish currency there. And so at least for some period, there would be a supply constraint on the currency. So there's no way that financial markets, as long as the country with its new currency could make the tax obligation stick, which is the vital first step. So Finland announces from now on, all taxes are going to have to be in the new currency, not the euro. And a country like Finland could pull that off because it's a sophisticated country with a proper rule of law and, stuff like that. And in that context, as long as they could pull that off, there'd be a shortage of that currency and everybody would be wanting to get it or go to jail for not paying your taxes. So at that very elemental level, basic insight level, all of the catastrophe theories are wrong. Initially, the currency would probably be strong against the euro. What happens in the future would depend upon the policies that the government followed with. Now, it wouldn't be an equal process across the space because Finland's in a much better shape than Greece would be. That's for sure. There's industry structure still in place in Finland, and there's strong industries up in the centre in terms of paper and things like that, although less so than used to. But there wouldn't be a catastrophe. There'd be an adjustment process. And the important point, in my view, would be the government would then be able to take responsibility for its own actions and pay the price or otherwise through the voting process. But it's a very complex thing, and I don't think we want to go into all the things about parking stations having to be free for 12 months because people would get stuck inside them without the right coins and all the rest of that.
Yeah, and it's also that in order to assess the likely consequences, we need also different scenarios about what about the process whereby the Finland would disintegrate from the euro. Yeah. Whether there's a kind of a total collapse of the euro system, or whether it's an isolated event, and whether there's time for transition, a kind of a managed transition, or whether everything happens all of a sudden, etc. I mean, they all have major consequences.
I mean, my preference is for an orderly dissolution. You went into it in an orderly way, go out of it in an orderly way. And then the consequences would be much less negative in the short run.
Yeah, but politically speaking, I mean, there is very little support in Finland for this kind of a move. And if things change politically in Finland, I mean, that would also indicate major changes in Europe as a whole. And then the likely scenario is a not so managed disintegration of the euro.
Yeah.
And
Oh, thank you.
I think it's very likely that the social conditions in the south, particularly Italy, and Italy's Greece was no problem to the Commission because it's too small. They could bully Greece and colonise it in any way they shape, but they can't do that to Italy. Italy's got a different cultural tradition. It's a very large economy and a large population. The likelihood is that conditions in Italy are going to continue to deteriorate and that there will be currency instability there. But I don't see it happening in Finland at all.
Yeah.
Okay, thank
And
you.
let me just yeah, okay.
Okay, one second. Okay, yeah, because I really want to. We are running out of time here, and I really want to get to the reform part as well. Just a quick comment. I really wasn't trying to tease out a disaster scenario. I was just thinking because I'm thinking of we need to identify problem first, then we need to identify the theoretical possibilities for a solution, and in the space of those theoretical solutions, if we agree that there's a problem with the current architecture of the Eurozone, one theoretical possibility would be to dismantle it and for example in an orderly way like you have suggested, Bill. But then when we are aware of these theoretical possibilities, then we can actually try to start thinking about what is politically feasible in a given situation, and that's my kind of approach to it. So understand the options in theory, then think about what can actually be done in practice. But anyway, to move on to how to reform then. So if we agree that, or you both agree that the current architecture is really problematic, and actually we are actually having a moment in Europe now that we are going to start after the German government at least will be formed. At the latest at that point we will start negotiations on the reform of actually the stability and stability and growth pact. So these rules that limit the deficits and rules that limit the sovereign debt or public debt to GDP ratios. So that's actually a reality now. We are going to enter those negotiations. For example, the Finnish finance minister already made a statement. She aligned herself, Annika Saarikko, with the so-called frugal countries and said that we need to stick to the rules that we have right now. The letter that she signed with the other frugals doesn't actually specify any numerical numbers for the deficit and none of that, but Saarikko in her own personal statement said that we should stick to the 3% and 60% rule. So the debate is beginning. So what do you expect from those debates? Do you think that there is actually chances that the fiscal framework of the European Union might be changed, and can we actually okay, we're running out of time, but what would be in the short terms, if you think about how should the system be reformed, what would your kind of recommendation for that be, and do you think that would be politically feasible to achieve?
Well, I'll go first. I've already given you my answer in my talk.
Mm-hmm.
I think that what could make the EMU work is not going to happen. Will this current suspension continue of the emergency conditions? No, I don't think there's a hope in hell of that happening. Will the Stability Pact be negotiated in a much more liberal way? I don't believe that will happen. Will Germany ever concede to a fundamental shift to European bond issuance and risk sharing across the space? No, I don't believe that will ever happen in the foreseeable future, in the functional future. Will the European Commission become a grant awarding body rather than a loan awarding body? No. The bias will be towards loans, which means you don't really get anywhere. In a federation, an effective federation, you help struggling member states by giving them grants, not loans. And so my view, and will there be any fundamental shift in the neoliberalism within the treaty? Well, that means you've got to get 27 states to simultaneously agree. And I think that's the problem of Europe. You're not going to get that. And I think the shift in politics in Germany has really been away from the left, even though people are saying it's a slight move to the left. I mean, Die Linke has been wiped out. And Olaf Scholz is no progressive. He's cast his political reputation on the Schwarz Null and or the Null Schwarz, whichever way you want to say it. But I'm very sceptical about Europe. I don't think it can cope with the dilemmas that it's facing in any progressive way.
It's just to clarify, I don't think the Schwarz null is probably a familiar term. So do you refer to the debt break system in the German?
Well, I mean,
law?
it's constitutionally, it's embedded that they've got to balance their fiscal position, and at the same time, the evidence is increasingly coming out. There was a major article in The Economist the other day about how this was vandalising their public infrastructure. I mean, Germany is falling way behind. Their dominant car industry has lost the plot in terms of its reliance on diesel technology, which is not going to survive the future. And they're way behind on electric cars, technology, etc. The strength of Germany is starting to become somewhat illusory, I think, and that's a fundamental problem for Europe, given the dominance of the German economy in the European economic prosperity.
Okay, thank you. Heikki, your thoughts?
Yep. The actual practices have already changed to a certain degree, which to me indicates a recognition that the underlying theories don't work. The system is not functional, and the fact that the European Central Bank is in effect providing the preferential access to the member states at the moment is also something that might not be reversible, even though there is clearly an intent, as Bill says, to return to these constraints, these rules, budgetary rules, the convergence criteria and the early 2010s new treaties and pacts and arrangements. But it might be also impossible. And how the European Union is being transformed is through crises, and perhaps the Italian crisis or something like that. Italy might be the most likely case of making the entire architecture of the EMU to verge on a collapse in the next couple of years or so. And if that happens, there are two possible outcomes. Every crisis is also an opportunity for the reformers, and this is, in my understanding, actually, the 1980s and 1990s, when many socialists and social democrats agreed with the neoliberal plan of the European Union, they were also counting on the fact that this will not be sustainable. That at some point there will be a crisis that actually forces the European Union to change itself. However, as Bill also mentioned, because of the hybrid nature of the European Union, it's partly kind of a quasi-federation for some purposes. For other purposes, it's a classical intergovernmental international organization. And the latter aspect makes it very difficult to actually change the basic treaty of the European Union. So you need actually the consent of 27 member states. In practice, I mean, that's not strictly speaking necessary, but you need the consent of all the major states anyway. And that's something that is very difficult to secure. So I'm not too optimistic myself, but I see more possibilities for transformation, and I also see the necessity for transformation, because otherwise, sooner or later comes the day when in my first table, I mean the D block, where the the EMU will face a crisis that leads to disintegration, that day will come, and unless there is a transformation of some kind. And for ethical, political reasons, it's also a moral choice in a way. I prefer to work as much as I can to transform the European Union rather than to dissolve it.
Can I make one last point? And this builds on something Heikki said, that the most stunning thing about the European situation, particularly since 2010, which is going to is causing and will cause increasing tension, is that in actual fact the euro currency is only surviving because the central bank is breaching in my view, the treaty. And so in effect, the system is so rigidly structured in law, it can only survive when it's one of its major institutions breaks the law. Now, I know there's been court cases where they've said that hasn't, but that's irrelevant in the real politic. The European Central Bank is maintaining the system by funding deficits. They're denying that, but that's what's happening. They've got a massive stockpile of assets now, and how that all plays out is creating massive tensions in the financial markets. They're layering new ways of doing it. So in the pandemic, you got the PEP on top of the app, and that's to me the most interesting dynamic in whether that provokes reform or not, because that's undeniable that it's reaching a crisis point and really banging the German heads against a brick wall. And that how that plays out is going to be, to me, the most interesting from my perspective.
Actually, yeah, I really agree with you, Bill. I think, and that's so. We need to. I think we need to arrange another webinar about the relationship of the monetary policy and the fiscal policy in the EU. That's a very, very interesting topic, and thank you for pointing that out. But now we have to be running out of time, so we have promised that the audience can also ask questions. So we need to move on to the questions from the audience. So Nina.
Yeah, so thank you very much for your lectures and the panel discussion. So the first questions are to Bill. Is it the ECB that decides what volume of government bonds to buy? And is it up to the ECB to decide the bond yield for each country? And a follow-up is, what does the ECB do with the interest and principal payments that they receive from the Treasury from each European government?
Well, I mean, obviously what's happened, and it started in May 2010 with the Security Markets Program, which was really an attempt to stop Italy going broke, is that the way bond markets work is that there's an auction in the primary bond market where selected dealers, who are mainly banks and financial institutions who have accreditation, who so-called make the market. And so there's a float. Each member state floats at an auction an amount of whatever they want to raise in terms of bond issuance. And the market makers then set the yields according to their perception of risk. And of course, if what happened in the GFC, because everybody knows that every member state has credit in the EU, in the EMU, has credit risk, which means that it can become insolvent because it's using a foreign currency. It can't actually always guarantee to meet all its liabilities in euros. And that's different. I mean, obviously, Germany's got very low credit risk. Finland's got low credit risk, but at the time, Greece had high credit risk, and so did Italy. And so what the bond markets do is factor in their perception of risk in terms of what yield they demand to lend the money to the member state. Now, what effectively has happened since then, and this is a worldwide phenomenon now, as Heikki said, is that the central banks, so the general point is that in any bond market, the bond investors set the yield if the government allows them to, whether it's a currency issuing government or not. That's the reality. But what we've observed is that in the European sense, but other markets too, even the Reserve Bank of Australia is doing this now, which is unprecedented. The European Central Bank effectively goes into the secondary market. So once the bonds are issued, they then are traded in a secondary market among speculators, and all sorts of different groups buy and sell those financial instruments. And what the ECB has effectively been doing is vacuuming up government debt in the secondary bond markets. They've been more or less in proportion with the so-called capital key, which is the proportionate contribution to the ECB capital from all the member state central banks. And by doing that, they effectively push up the price of those instruments, those bonds in the secondary market. And by pushing up the price, they drive down the actual yield because of the relationship between price and yield in so-called fixed income assets like government bonds. And by doing that, they then condition the primary issuing process, the auction process, through competitive forces. And so, in effect, what the central bank has been doing by construction is setting yields. And of course, they had to do that because otherwise the yields on Italian debt and Spanish debt and Portugal to a lesser extent would have gone through the roof, and those governments would have gone broke. So the central bank has been setting the yields. They've been doing that all around the world now, as Heikkis said. And a fundamental shift in macroeconomic thinking has occurred, not just in Europe, but everywhere. And that's been because it had to happen because the deficits were going to be so large to everywhere to deal with the existential crisis that was posed by the pandemic. And capitalism is now on state life support everywhere at differential degrees, and the central banks had to come out of their caves and fund all of that.
But that also implies that it is very difficult for them to raise interest rates anymore. And if there are any reasons like decline in the value of the US dollar or inflation or some other reason that they need to raise the interest rate, they actually risk a worldwide debt crisis.
Yeah. So we've also seen in this last 5 years approximately, but it's accelerated in the last 2 years. We've seen a fundamental shift in policymakers from reliance on assignment of policy responsibility of monetary policy to fiscal policy. And as Heikkis said, it's going to be very hard to unwind that now because of what's happened. And if they try to unwind it in conventional terms with fiscal austerity and interest rate management, the world economy will collapse.
Yeah. So to Heikki from Bonn, apparently Heikki made a normative statement about the compatibility between MMT and democracy, and Bonn is asking, in reality, couldn't MMT be accompanied by any type of political regime, including autocracies, just like many economic policies, such as industrialization, can be pursued by democracies or fascists or etc.?
Indeed, I mean, that is the case. And this is something that I also wanted to, a part of the argument that I wanted to make, that there is no necessary correspondence between sovereignty or monetary sovereignty in the MMT sense of the term and the type of regime in any given country or system of governance. I actually know that Bill is writing a book on this topic, in fact.
Yeah, I mean, the point I make is that an understanding of the way the monetary system operates and the capacities that the currency issuer has in that context is one step. But then to operationalise that into policy space, you have to overlay that with a value system, with an ideology. And so I could have my policies would be predictable in terms of public enterprise, public schools and hospitals and caring for the poor and full employment. Yet a person with a right-wing ideology would have a totally different application of their understanding and their use of the government capacities. And you could have a total totalitarian military state using locking up all dissidents and anybody who said boo. So, that's MMT isn't a ideology in that sense. Obviously, the clear distinction between values and understanding is not there, but I make that just for argumentative reasons.
Well, I would argue that behind post-Keynesian economics, I mean, there are also certain values. The idea is to see things not from an atomistic perspective, but from the point of view of the whole, in order to avoid the fallacy of composition, etc. But there is also an inherent idea that society is more than the sum of its parts, and that the people are socialized into a system that determines their possible places and position in society and so on and so forth. But that doesn't prevent the MMT theory, for instance, being used in a technical way to support basically whatever aims.
Yeah, that's right.
Yeah. So last question of the day. Apologies to those who sent questions later, but Bill has like bedtime coming up and all of that. So one last question of the day, and you can probably answer this relatively briefly, Bill, because we already touched upon it during the panel discussion. But Bon asks, what's the scope for developing country to adopt MMT? So heavily indebted in foreign currency, largely remittance-dependent financial flow and service-oriented economic sector?
Yeah, well, first of all, you don't adopt MMT. MMT isn't a regime that you can shift to or shift away from. It's about monetary systems, MMT. And so we've all got monetary systems, and so MMT provides, in my view, a better understanding of what those monetary systems do. And to go back to what I said about a country being poor, countries can have their own currency, and in that sense they're sovereign, but there's so many different layers of constraints depending upon the nature of that country and the number of resources they've got, their governance and education systems. And so a country, I've done work in developing countries, and I think I understand fairly clearly what their problems are in terms of import reliance, particularly of food and energy, reliance on remittances from workers that have gone away to work in other countries where there's more opportunities. And these constraints are really binding and very difficult to break away from. And you have to do it in a staged, managed, careful, slow process. So for example, you've got to start reducing your reliance on imports and invest as best you can in import competing industries. You've got to reduce your reliance on imported food by investing in sustainable permaculture and sustainable agricultural techniques and those sort of things, and not take the IMF export-led model and completely cut down all your forests like Mali did, and then be left with nothing, just a huge amount of international debt. And so invest a lot in your governance structures so that you can attract proper foreign direct investment that's not speculative in the hot money sense. And how you do that is really problematic, and how you do any of that's very difficult. And and the preferred solution is that all of us rich countries get together and say, right, we're going to do it, help them. And the vehicle that we've got to do that at the moment is the World Bank. The vehicles is the World Bank and the IMF, and they're disasters. They're neoliberal attack dogs. So it's a huge amount of effort going to have to be done. But those countries have to do it slowly, surely, and whether they're successful is a moot point.
Yeah, let me just add one thing about global institutions, how important it is to actually have the right kinds of institutions, not the IMF and the World Bank as they stand today, but better institutions that in fact support those kinds of processes that are in line with the development of those countries. I mean, thinking about the terms of trade, or thinking about the developing systems of education in those countries, thinking about the World Monetary System also in the sense of making it possible for those countries to follow counter-cyclical macroeconomic policies, but also to harness resources for public investment programs and those kinds of things. So there are plenty of things that can be done by reorganizing the institutions of the world economy. But not everything can be done from the outside. I mean, you need serious commitment on the side of those people who live in those places. And there are all kinds of vicious circles there, including corruption and conspicuous consumption and rentier state and all the rest of it. So it's difficult, but I mean, experience shows that it's possible to overcome those kinds
I think
of
the last point I'd make is that one of the fundamental things that we should be advancing in debate, and people should be talking about it a lot, is that the advanced countries of today would have never got there by the policies that the IMF and the World Bank expect the least advanced countries to follow. That's the reality. And, you think back to the 60s, South Korea was a very poor country. And it defied the IMF. It defied mainstream economics in terms of comparative advantage and all of that stuff. And it went its own planned way with state and business working together. And they've become, in material terms, wealthy. Now, whether you want to live there is another question, but it's a wealthy country now. And they did it in a way that is quite different to what we expect and what the World Bank and the IMF apply. And that's huge in my view.
Great, thank you. Does Konsta have any concluding remarks?
Nothing too special. This was probably the most interesting economic debate in Finland in a very long time, in my view, and it was very, very good to have both of our speakers. And I want to still one more time thank both of you and all of our people watching. And if you have any feedback, please leave a comment, and we'll be wrapping this up now.
Thanks.
So thanks everybody. We have to see to organize something like this in the future also. And good night to Australia. We'll continue the day here in Finland.
Thank you.
Bye bye.
Thank you.